everyone, welcome back to our channel. So we took a short hiatus last year, we hope you don't mind, but we have published our outlook for 2020 last week. So I'm just here to very quickly run through it with you. I'll leave the link down below if you'd like to read more, or you can find it on our website as well. So we tried a different style of publication this year and structured it into 10 different conversations or 10 different questions that we just couldn't avoid for 2020. So first and foremost, let's look what happened in 2019. The global economy is expected to grow at 3% in 2019. That's the slowest since the global financial crisis in 2009. But equity markets was a surprisingly good year, with one of the best performances in the last decade. The Nasdaq finished 38% up from 2018, followed by the S&P at 33% total returns. For 2020, global GDP growth forecasts are coming in very divided, from as low as 1.2% all the way up to 3.7%. On equity markets front, we think that the first half will likely be positive, followed by some softening in the second half as the US elections in November potentially weigh on investor sentiments, and as phase 2 of the US-China trade talks potentially resume. Speaking of which, the trade war is far from over. Phase 1 is just about to be signed, but we think that phase 2 could get much uglier as the battles move towards the tech and finance sectors. And potentially also involving China's economic and political structures as the US tries to slow down China's growth. In China itself, we're already seeing some slowing down, worsened by higher unemployment rates as well as higher inflation due to skyrocketing pork prices. However, again, we see a completely different picture in the financial markets. The Shenzhen Component Index delivered a 44.1% return, followed closely by Chinex's 43.8% return. So, to better understand what's happening in China, though, we think that understanding their fiscal and monetary policies is very crucial to be able to chart where future development or growth areas could be. So for 2020, we believe that development efforts are focused on gaining and maintaining stability, especially in areas of employment, finance, foreign trade, domestic and foreign investment, as well as development targets. And as a plus point, these efforts are positive news for emerging markets, or EMs, which have severely underperformed developed markets' equity benchmarks in the last 2 years. EMs tend to be more dependent on China's economy more than the US economy, and so they definitely stand to benefit from China's rising factory orders and industrial metal prices. And among the EMs, we are most positive on Taiwan, given its exposure to the critical semiconductor technology sector. The upgrade from 3G to 4G in 2012 to 2014 saw a re-rate in Taiwanese tech stocks, ex-TSMC. PE valuations rose from 15 times to 18 times, and so we expect the ongoing upgrade from 4G to 5G to provide a similar re-rating for these Taiwanese tech stocks. On the topic of technology, we have concluded that we are not in a tech bubble, although yes, we think that there is some overvaluation relative to historical levels. We therefore recommend investors to tread lightly and invest very selectively, as risk to reward ratios are well elevated. AI, 5G and IoT, or Internet of Things, will serve as the next drivers for tech, with cloud computing being the unifying support infrastructure. So among the big names, we lean towards Chinese big tech such as Alibaba and Tencent, as they continue to see favorable tailwinds from the Chinese government as well as the Chinese consumer. In the semiconductor space, we see scale becoming increasingly important, a similar trend apparent in data centers as hyperscale data center constructions continue to rise. And of course, no tech conversation with us will be complete without an AEM recommendation. They have recently raised their earnings guidance and have since gained about 10%, I think. In our list of top recommendations, though, AEM does share the spotlight with gold. So with sluggish growth, low inflation, and low yields extending into 2020, coupled with increasing geopolitical tensions globally, we believe that the need for a safe haven asset will always remain, leading us to a target price of about $1,700 per ounce for gold. Moving along, while we think that gold has to be a key asset allocation for every investor, we see forecasts for peak oil demand being revised to earlier dates continuously. Overall, we expect Brent oil prices to remain within the range of 60 to 70 US dollars per barrel, but with some positive upward bias as emerging markets recover and the OPEC Plus cuts production. Therefore, we do still see some short-term opportunities to invest in oil and gas companies, as we believe that the oil price risk premium will not only return but will be more persistent this time around. But we must highlight the need to be selective. This is especially so as global concerns on climate change propel a shift towards lower carbon intensity sources such as wind and solar. Progress on ESG has been stronger and faster than ever, especially as sustainability-aligned companies start seeing positive effects on their bottom line and market performance. Along with greater investor demand, we expect only an upward trend for sustainable companies as the European Union begins to outline the world's first comprehensive green financing rules. The rules and regulations are expected to be solidified by the end of 2021, with implementation and enforcement expected by the end of 2022. So despite being only applicable in the EU, we believe that it will create ripples globally. Finally, to address the elephant in the room, yes, you can still buy REITs, but please be selective. We are still positive on our recommendations for EC World and Capital DC REITs, as they are underpinned by fundamental growth trends. But we also see much room for growth with those with a lower gearing, as MAS looks to increase leverage limits to about 50%. This will no doubt be beneficial to REITs such as CapitaLand Commercial Trust, SBH REIT, and Fraser Centrepoint Trust, all of which have debt levels below 30%. So that's all from me today. If you'd like to read more on our report, again, I'll link it down below, or you can find it on our website. Thanks so much for watching, and we'll see you in the next one.